All right. Okay. So welcome to another call. This call will be looking at liquidity. We'll be talking about liquidity. If you were in my last call, I broke down some basics in Forex for beginners. So that video is on YouTube. So if you're in my Telegram group, you can just check my YouTube channel and rewatch that. I'll also post this one on YouTube after this class. So yeah, so that's that. So let me share my screen. Let me share my screen. Okay. All right. Hope everybody can see my screen. All right. Can we see my screen? Let me check the chat to make sure everybody's. Okay. All right. Let me just put a chat box at this side so I can see what's going on. Okay. So in this session, we're talking about liquidity. And but before we go into that, let's just talk about stop loss and take profit. And the reason why I'm talking about this is so we have a basic understanding. I know someone asked me during the week, what is stop loss and what is TP? So the stop loss basically is how we manage our risk. It's how we protect our capital in the market. It's how we manage our risk and how we protect our capital in the market, because we cannot guarantee where the market is going to go. So we have to put stop loss in place to protect our capital. And why TP or take profit is our intended direction, where we expect the market to go, our targets. I hope that clarifies. It's actually very simple. So these are live trades that I took. So in these trades, we can see that I had stop loss and a take profit. So let's look at this example now. So here I was predicting a price was going to drop, and in the market, when you have a prediction or when you have done your analysis, it's always good to set a stop loss. So in this, I set a stop loss around here. So what this means that if price didn't go in my favor, if it went the opposite direction, I will have lost a certain amount of money. Do we understand? So if I don't have this setup, it means if I don't have this setup and price goes against me, it's going to be really risky because I can lose a whole lot of money unplanned. But the stop loss helps to minimize the risk. So this is another example I took. I was predicting a buy, but price went against me. I was in profit for a bit, but it went against me. So in this kind of trade, I won't lose as much as I'm supposed to because of this stop loss. So the same thing here. Same thing here. Price went against me and hit my stop loss. So I lost a particular sum of money, then it went to my direction. So if you don't have these stop losses in place, you lose more than you're supposed to in the market. So it's always important that you have your stop loss and your take profit set. And I always advise my mentees to always have a positive risk to reward. And what I mean is, whatever your stop loss is, your take profit should be at least ×2. So if you're risking $20 in a trade, the take profit should be double of that. So if you're risking $20, you should be looking at making 40. So if you have this risk to reward mentality in place, then most of your trades are always going to be overall, you're going to be profitable in the market. Even though you lose, let's say you have 10 trades and you lose 6 of them, because of your risk to reward, you're still going to end up in profit. So it's important we have all those in place. So hope that clarifies. So let's talk about liquidity. So what is liquidity? Liquidity is money. Liquidity is another word for money. And it can be in form of buy stops and sell stops. Liquidity can also be seen in trend lines, support and resistance, etc. So why liquidity? Liquidity acts as a draw on price. It is a good area to make entries and also exit. So it's a good area for you to enter a trade and a good area for you to exit a trade. So what this exit means is a good area for you to take profits as well. So it also helps us to understand structure. So what are the areas that liquidity is found, or types of liquidity? So we have swing high, swing lows, above and beneath consolidation, session highs and session lows, daily highs and weekly highs, daily lows and weekly lows, equal highs and equal lows, and trend lines. So I'm going to go through all of this so we can have an understanding. It's actually really simple. Okay. So swing highs. What are swing highs? So in the last call, I talked about trend, when we have an uptrend, a downtrend, etc. So when we have an uptrend now, liquidity is going to be formed in the upside. It's going to be found in the upside. So let's look at this. So we have price moving up, down, up, down, up, down, right? So liquidity is going to be at the top. Liquidity is going to be printed at the top because price is only going higher. Do you understand? It's going to be above all these highs. So in an uptrend, it is not advisable to trade in the opposite direction. When the trend is up or when the trend is down, you do not trade opposite because it's going for liquidity, and liquidity is going to be at the top side. So it's going to be targeting all the top liquidity, because at these areas, we are going to have some people that want to sell. Do we see that? Some people will see this trade, will see it retracing and be like, oh, okay, maybe price wants to reverse. They'll sell. And when they sell, what happens? Price is going to run them out. It's going to take all their money. So you have to trade with the trend, and we have to know that liquidity is going to be above all those swing highs. So anytime, please can we mute our mics? So anytime price retraces, you want to look for that entry towards the upside. Okay. So next we're looking at swing lows. So it's the same thing. So if we see price making lows, okay, we know that liquidity is at the bottom. So whenever price retraces to a premium price, whenever it retraces, you want to sell, because you know all those money is sitting at the bottom. All those money is sitting at the bottom. And if you notice this, when it's in a trend, it doesn't violate it at all. There's no violation. It keeps on trading like this. You don't see price going deep like this and continuing buying. It respects the uptrend. It's respecting the lower prices and it's violating all these upper prices. So it's the same thing for the downtrend. It's respecting the upper price and violating all these lower prices. So we have to understand, when we are looking at the charts, we have to first identify the trend. When we identify the trend, we target where the money is at. Okay, so let's go to above and beneath consolidation. So whenever you see price moving like this, that is, there's no particular direction. Whenever price is moving sideways, okay, there's money above and beneath it. You do not trade when price is consolidating, because some people are buying here, some people are selling here. We have breakout buyers trying to buy here. We have breakout sellers trying to sell. We have people trying to make money up and below. But what this means is that price is just generating liquidity. So all those people that are placing buys, placing sells, placing buys, placing sells, price is generating liquidity because it's going to do something. It's going to run both up and down. It's going to take all their money. So people that feel like, okay, price is going to go up, it went up and took them down. People are thought that price is going to sell, it broke them up from here. So when we see price consolidating, we do not enter the market, we do not trade. We wait for it to break below or break above, then we look for an entry. Okay, so let's keep moving. Session highs and session lows. So the last class I spoke about the sessions that we have. So we have Asia session, London session, and New York session. So it's important to know that there's liquidity above and below sessions. Liquidity is going to be above or below because we have different times and days people trade, different countries trade. So in the Asia session, we're going to see people that prefer to trade in Asia. People will be buying or selling, whatever the case may be. So what this means is when, for example, now this particular one, we saw people buying in the Asia session. Okay, price went up. Even in London, people still kept on buying. Now, what happens in New York session? New York session took away the liquidity below London, liquidity below Asia. It completely ran their stops. So everybody that held the trade, that held their positions from here and here, price ran all of them, took their stop losses. And what it usually does is when it takes their stop loss, it may still continue to go in the actual direction. Do we see that? So it's important to always understand where the money is at, understand the trend, understand exactly what is the market doing. Okay, and if we understand liquidity, we have an idea of what those people want to do because we don't move the market. Us retail traders, we don't move the market. Our $100, 1,000, 10,000, 20,000 has little or no impact in the market. The people that move the markets are the big banks, the big institutions, all those big organizations. They move them. They're the ones that influence the market most of the time. Then we have fundamental news that moves the market in minutes, but most of the time, there's the big banks and institutions that move the market. So we have to know exactly what they are doing so we can trade alongside with them. Okay, so equal lows, support. So when you see price touch an area 1, 2, 3 times, okay, I term it as equal lows. So let's look at this now. We saw price, it did this, okay. This now, retail traders, what they do is this. When price touches an area multiple times, let's say 1, 2, 3, 4. When price touches an area multiple times, for them, this is a strong support. You get this is a strong area. So the idea is when price touches an area multiple times, for example, price touches the support multiple times, the idea is that price is going to buy because this is seen as a strong zone. So they believe that this area is going to keep on holding, price will keep on respecting this area and going up. But what price is doing is price is generating liquidity. So whenever they buy at this place, price will keep on generating liquidity. Price will keep giving them more reason to buy. They buy again here. They buy again here. This is also an equal low, relative equal lows. So when price is satisfied with, because all these touches now, we have millions of retail traders entering this trade, millions all over the world. So when price is satisfied with all these stop losses here, satisfied with all these entries, all these positions, price is going to run every single one of them. Every single one of them. So the more experienced or more advanced retail traders, they probably would have, maybe if they bought from here, they probably would have, taken profit around here or around here, or whatever their strategy is. But us smart money traders, we know exactly what they're doing. We know exactly what they want to do. They just want to generate liquidity for them to run it out later. You see that? So it's important to know exactly what these people are doing in the market. So you have to be patient. And it's the same for equal highs. Same for equal highs. So the idea is when we have equal highs, this is not really a good example, but okay, when we have equal highs, the retail traders believe that the price is going to drop. Okay. So I took this trade actually. Uh, it was equal highs here. So I know what they want to do. I know that whenever they do this, they just want to generate liquidity and run it out. So I positioned myself for this buy. I entered somewhere around here. Yes. I was in profit, but I think this was a news. This was a news event that caused this. That's why it took me out. But I know exactly what they want to do. So once I saw this, I knew that they wanted to go higher. So I just looked for a reversal here, then I took the buy. But it's the same concept for equal highs as well. When we see price touching an area, touching a resistance 1, 2, 3, 4 times, that zone, that strong zone, is termed as equal highs, and price is only going to generate liquidity to run it out later. So trend line liquidity, so price is going to be above and below trend lines. Okay. So when the market respects a trend line, top orders are being placed beneath every touch of that retail bullish trend line and above every touch of that retail bearish trend line. So this is a retail bullish trend line. So what this means is it's basically the same thing as support and resistance, but only in a trending market. So whenever you see this, see one touch, two touch, three touch, they know exactly what you're doing. They want you to enter all these positions. They want you to enter. They need your money. So, so when you enter, they will just generate liquidity. They run it. So same for a bearish trend line. Okay. They see you, they'll create this opportunity for you to sell. They'll create it. Then when they're satisfied with the positions, they'll run it later. You see what they did here? They allowed you to sell, then they bought. So um so it's good for us to understand that. Then lastly, there's something that we all need to know, which is the AMD distribution, principle, which means accumulation, manipulation, and distribution. Okay. So what A means is A stands for accumulation. Okay. So what it means is there's no true intent. It takes out early buyers and sellers. Okay. YM, the manipulation is a fake out or false move. And D, this is supposed to be D, sorry. Okay, distribution and expansion, same thing. So D um is the true direction of the market. That's the true intent. Or E. So see this now. Price will accumulate. Okay. So after it accumulates, it manipulates. So a lot of people will have bought here thinking that okay, price is going higher. But the true intent, the true direction of the market is down. So price does this a lot, especially within sessions. And if you have seen my chart before, you see, sometimes I always have this blue rectangle on my chart. I like to wait for price to run above or below that rectangle. Then I sell or I buy because I know exactly what they're doing. I know exactly what they want to do. This AMD principle, it happens a lot. If you go to our charts, you will see this happening so many times, almost every day. So price will accumulate, to manipulate, then it will expand. Okay. So look at this example now. What are we seeing here? Price is accumulating. Okay. So when you accumulate, because people are buying here, people are selling here, people are buying, people are selling. So it's just generating liquidity. So after it does that, it's going to run everybody that is selling, every single person that stop losses to be taken, unless they have like a 50 pip stop loss. Okay, that's their luck. But anybody that put the stop loss within here is going to be violated. Then what's the true direction of price? Higher. Okay, so it does this. Price will accumulate, it will manipulate, then to expand. Okay, so let's always bear that in mind. So this is an example I took in an MT4. So it's basically the same thing. We see consolidation here, price consolidating. So whenever I see this, I just mark it up because I know that there's money. Money is going to be here. So when price now moves the opposite direction, I just wait for a reversal sign. And when I see that reversal sign, then I enter the trade because I know that price, the true intent is to run all this money, take everybody's money here. Okay. So any questions? It was a very, very quick session, but I hope I was able to explain. Okay, Bernard, yeah, please go on. Please. You can unmute your mic.
Hello everyone. Good
Hello.
afternoon.
Yeah, what's
When you
up?
were talking about relative highs and lows,
Yeah, yeah.
sorry, I came in a few minutes late. Isn't it best to since you know what they are doing, isn't it best to get ahead of them? Like since okay, you know that they're trying to generate liquidity, you can
Mhm.
collect money from those relative highs, then get out as soon as possible. Then since you know that they're just trying to generate liquidity and come down, you can get it as early as possible and still make and get a better position for when the price either drops or increases. I don't know if I'm making sense to you.
Yeah, I get where you're coming from. So what you're saying is, if you see something like this, is it not better to
Exactly.
just buy than just buy and just take profit? Is that what you're saying?
Yeah. Yes, exactly.
Yeah, okay. That is a retail way of trading. Do you understand? So like if you do that, yes, definitely you might make money. Okay. Like for in this example now, you will make money. But um that is if you do not get greedy. So because some people they might enter this and feel like, okay, price is not going to come down. Price is going to keep on going higher, only for them to, reverse on you. So as a retail trader, if you want to position here, you have to have quick targets. So you can target somewhere like here, target somewhere like here, then be comfortable with your profit. But the kind of trader I am, uh, or the kind of traders community I'm trying to build, I want us to understand that when they do this, we know they're generating liquidity, and we know that this is not the true direction. Because now you're going to be, as a retail trader, you're going to be unsure of where to take profit from. Okay, unless you just have like small targets. But if I enter a trade based on this reversal, I know that price is going to run all this money. So if a retail trader is making like $100 from this move, I'm going to probably make like $1,000 from this whole move because I know that they'll take this, they'll take this, they'll take this. Then I can decide to take profit at this around this area, or maybe after they take this liquidity here, I can decide to take my profit here because is like I said earlier, it's good to take profit after price has taken liquidity. So we want to get in when price has either taken liquidity or we want to exit when price has taken. So I don't know if I'm making sense to you, Bernard.
You are, you are, you
Yeah.
are.
So it's best to understand this. When you understand this, you know that okay, you can maximize your trade. You don't want to be unsure because you can never know when they're going to reverse. You get me? So they could have reversed here. Okay. And as a retail trader, if you might be scared, you might be panicking if you see price going down. But um, how I trade is I want to see them generate more liquidity. When I see those liquidity, then it just gives me the confidence to enter the trade because I know that I'm going to run everybody's money, and I'm comfortable with that. So yeah, hope that helps. So
It
any
did,
other
it did.
questions? Right, thanks, man. Any other question? Um, any questions? Are we good with liquidity? Do we have an understanding now, or is there any confusion around this liquidity? Yeah, Ezekiel, yeah. You can unmute your mic and ask. Okay, sure. So you can type. Please, in case this call ends, let's rejoin again because the Zoom is telling me I have a minute left. So in case it ends, let's just rejoin again with the same link. So Ezekiel, yeah, you can go on. Okay. So when the market is making liquidity, how do we identify entry opportunities? Okay, I'm going to answer a question right now. How do you know price about to run the liquidities? Okay.